This is Barry Zalma speaking for Claims School Incorporated's blog, Zalma on Insurance. Today we're going to speak about Claims Commandment number 7, that thou shalt never lie to an insured. Insurance is and has been since the first policy was carved into a clay tablet in ancient Sumeria more than 3 million years ago, a business of the utmost good faith. The principle of utmost good faith was, I believe, first stated in the English-speaking world in the British House of Lords by Lord Mansfield in 1766, in a case where he concluded that the duty of good faith rests upon both the insured and the insurer, and held the insurer to its knowledge at the time the policy was signed. The insurer, like the insureds, took the premium paid by the insured, knowing the condition of the security provided, and could not, upon loss, claim the insurer was deceived. The case was called Carter v. Boehm, 3 Burr, 1905, decided in 1766. As the old maxim says, honesty is the best policy. There is no excuse for an insurance claims professional to lie to an insured. Not only is a lie to an insured a failure to act with the utmost good faith, but it is also an action fraught with danger for the claims person and the insurer for whom he or she works. Keeping up a consistent lie is almost impossible. All definite statements can be corroborated or proven false by further investigation. If a lie is about a material fact, the falsehood will be proved to the expense of the insurer. Lies to insureds, even when done for what the claims person believes is a good purpose, will invariably cause the insurer problems. Lies created on the run invariably include internal contradictions. A lie told to an insured can be and most certainly will be used by the insured to prove that the actions of the insurer were made intentionally and in bad faith, such that the insurer will eventually be punished with punitive damages. For example, in Allison v. Fire Insurance Exchange, a Texas Court of Appeal decision from December of 2002, a major punitive damage award was obtained by a plaintiff who presented evidence from the adjuster who admitted on the stand that she lied to the plaintiff about the authority to resolve a claim for mold damage. Although the case was reversed because of an excess verdict, the lie cost the insurer a great deal of money when the case was eventually settled, and started a spate of bad faith cases claiming refusal to pay for mold damage because of the excess and punitive judgment at the time of the Allison case. Claims people get in trouble when they fail to tell the truth to the insured about, among other things, the following: the check is in the mail. There is no problem with coverage. I will pay the fees of the lawyer of your choice. The claim is being reviewed by senior management. I need another 30 days to complete my investigation. I need a copy of your policy. I need you to go to all of the places where you bought the stolen property to get a receipt. I will hire a contractor to rebuild your house. I don't have authority to settle your claim. I don't need to do an investigation to know your claim is not covered. I have confirmed coverage, or any other statement that is not true. California Insurance Code Section 790.03 H close paren 1 close paren provides, quote, knowingly committing or performing with such frequency as to indicate a general business practice, any of the following unfair claim settlement practices exist. 1. Misrepresenting to claimants pertinent facts or insurance policy provisions relating to any coverage at issue. Similarly, the California Code of Regulations 10 CFR 2695.5 provides, quote, no insurer shall misrepresent or conceal benefits, coverages, time limits, or other provisions of the bond which may apply to the claim presented under a surety bond. This should be self-evident to anyone involved with insurance claims. It is a statement of prudent and common claims handling. Although this regulation seems to apply only to surety bonds, it also applies to any type of insurance. Nothing can be gained by an insurer concealing or misrepresenting information about the policy or the surety bond. Claims staff should be warned that violation of this regulation, warned that lying to an insured will be grounds for discipline and certain loss of employment. On the other hand, proving that insurers and insured play the insurance claims game with a different set of rules, a mere oversight or honest mistake will not cost an insured his or her coverage. The lie to the insurer must be willful. This was decided by the U.S. Supreme Court in a case called Claflin v. Commonwealth Insurance in 1884 and is still the law of the United States. This video was adapted from my blog, Zalma on Insurance, which is available free to anyone who clicks on the URL zalma.com/blog. You can subscribe to the blog and will be notified of every blog posting, which usually occurs 5 days a week. You can also subscribe to my YouTube channel and my Rumble channel, and if you do and view the videos, please click on the like button or the Rumble button as you do so. And you might also find it useful to subscribe to my Locals community and to my Substack publications. Thank you for your attention.